Welcome to Classic Value Investors and Microcap Explosions. This is Mariusz Skonieczny. Today we're talking with Calvin Froedge. Calvin, thanks a lot for joining me.
Yeah, thanks for having me.
Lots of things is happening. Lots of things happened in the tankers. I know you're following it a lot closer than I am. So let's do this. So what has been happening over the last 4 to 6 months of interest that you could share?
Okay, so spot prices are still pretty terrible. Spot rates are still pretty terrible, but stocks have moved up a lot. So basically, what happened was after the contango, partly because people had this narrative sold to them, partly because of the whole "it's the end of oil" thing, demand is permanently impaired, blah, blah, blah. People sort of thought that their tankers weren't worth anything, so they sold them cheap. And the analysts were all, reiterating sell at the bottom. And now the stocks are up 50%. I think Scorpio was up 80 or 90% from the lows. So that's more or less what's happening. The stocks are trading up closer to their NAVs versus some of them got down to 30 to 40% of NAV back in September, October, November. The NAVs have come down quite a bit because of falling asset prices, but the asset prices seem to have stabilized a lot. The price of steel is also putting a floor under the value of older tonnage. At one point, we hit almost $500 for scrap steel. I think a couple ships were actually scrapped near that $500 mark. There has been a little bit of tanker scrapping this year. Anyway, that the older tonnage is kind of getting held up by that. Newer tonnage, it's kind of a bifurcated market. Newer tonnage is still getting not great fixtures, but profitable fixtures. That's, I guess, a quick high-level overview of what's going on in tanker land.
So it appears to me that even though the rates are not great, people are just looking ahead and making their bets on where the rates are going to be.
Well, I think people are looking at what happened in Japan in the last couple weeks. People are looking at what's happening in Texas. People are looking at the rates in the Pacific, and especially in Australia, have remained high. There's been a lot of refinery closures. And I think people are basically just starting to say, oh, wait a minute. Actually, we need fossil fuels. Actually, these companies aren't all going bankrupt next week. What's remarkable is some of these analysts said, oh, it's a disaster. It's the scariest thing that could ever happen to any of these companies. It's going to be terrible. And yeah, rates sucked. Rates came down. But a lot of these companies were still cash flow positive. Euronav in Q4, despite having booked some of the worst rates that they've booked since 2018, they were still cash flow positive. So it was definitely a big overreaction after the contango. People got incredibly bearish, incredibly pessimistic. And since then, the steel price has come up a lot. And yeah, people are seeing through to the other end of this thing. They're saying, well, I've been stuck at home for a long time. I know I want to get out and travel. There's millions of people in the U.S. getting vaccinated every day now. So I think people are starting to look past this, and they're realizing that maybe some of the forecasts on oil demand were way more bearish than was warranted. For example, one report on new car sales in the U.S. in 2020, like literally three quarters of car sales were trucks, SUVs, and hatchbacks. Used car sales went crazy. So that doesn't really fit the narrative of everybody's going to be driving an EV next year and nobody's going to be using oil. and now we've got all these shortages in oil. A lot of the flows are impaired from this cold weather. I think 2 million barrels a day of U.S. production is curtailed right now. And for whatever reason, people are kind of trading tankers, it seems, on the oil price and taking the stocks higher with the price of oil. I don't think that is the right way to look at it, but I think people are maybe having a little bit more confidence in fossil fuel companies still having a future.
How does the oil demand look? Is it recovering, or are you following that?
Yeah. So Brazil, India, and China, oil demand is actually higher year over year. It's still in recovery mode in a lot of places, but there are certainly indications that oil demand could be back at that 100 million barrel a day mark relatively soon. I think Goldman Sachs is the most bullish on that forecast. Goering and some European name I can't pronounce, Rishog or something like that. But GNR Research, they also have a really bullish forecast on oil demand, and they also took a lot of issue with the EIA forecast and said that the assumptions that they were making in the EIA's forecast were basically impossible. Let me see if I can bring up exactly what they said. But while I'm looking for that, go ahead and ask me anything else you want.
I saw that you had a little bit of an issue with one particular analyst on Twitter. You were saying that you don't like how they are just giving out price targets, and that's not really valuable or fair to the investment community. Can you elaborate a little bit on what you meant by this?
So yeah, okay. So one of the reasons that I got into tankers in the first place was because I found the research from Cleves, from Joaquin. And I definitely feel like I was manipulated based on not Joaquin changing his opinions, but literally changing the goalposts. Okay, let me give you an example from DHT. Okay, so in November of 2019, Joaquim had a $9 price target on DHT and a $47,000 spot forecast for VLCC rates in 2020. In the 4 quarters after he made that call, DHT averaged 66,000. So they averaged a lot more than he thought they were going to make, and he cut his target price in half to 450. So, TK is another really good example of that. He had in 2019, before Costco sanctions, before any of the positive developments with IMO 2020, before all the money that TK made on the contango, I mean, nobody saw that coming. Nobody saw TK paying off half of their debt, or DHT paying off so much debt, booking all those profits. That was a scenario absolutely nobody saw coming. Okay, and granted, nobody saw the pandemic coming either. But for a company to dramatically outperform your expectations and then cut the target in half and start focusing on some bearish elements, reiterate those sell ratings when the stocks are trading at the lows, and then after the stock prices have moved, upgrading to buy again with much higher price targets, I just feel like that kind of behavior is not defensible. It's just not intellectually honest at all. And I don't know how Cleves makes money. I don't know what their trading book looks like. I have no idea. Okay, so I'm not saying that he's front running his recommendations and using and profiting off of manipulating people, but the scenario that I just laid out there to you, basically, what happened with in the market and his price targets with DHT and TK, I just don't think that you can defend those actions in any rational way.
Interesting. Thanks for that. And how I know that you kind of went on your own and started compiling tanker data. I believe you have a website, tankerdata.com. Like, what is this? And like, is this a subscription model? Like, can you talk about how you decided to start it and what it is exactly?
Right. So as I started getting really into the tanker trade, obviously that meant comparing a lot of these companies side by side and doing a lot of the calculations, for example, on NAV myself, and also keeping track of the spot rates. So, I was looking at all of this for months, and in January of 2020, or maybe it was December, a broker basically approached me and said, "Hey, look, I've got a lot of rate and fixture data. I'd be happy to share it with you. I think I like what you're tweeting. I like your posts, and I'm happy to help you get into this industry." So, a couple people just started popping up like that, kind of saying, look here, look there, put this together. And a few months later, I had a subscription service. It was kind of something I've wanted to do for a long time. I've always done software consulting work and had never really taken the time to take a few months and really focus exclusively on my own product. And since I was already so deeply involved in the tanker trade and the tanker research, I thought it was probably the best place to focus. They say the best product ideas are the ones that solve your own problem.
Okay, so how can people use it? Like, what can they do with this data? Like, does it help them with long-term investing, or does it help them to be a trader? Why should they look at it?
Well, I think it helps you with a couple ways. First of all, you've got the data on the NAV calculations, and you can see how those things are broken down. So you don't need to go and get the fleet list and then value each ship individually. You can look at how we break the value down, and that changes based on the changes in the vessel values. Now, it might not be 100% real time. If somebody sells a ship, we don't immediately update the numbers. If a value changes, it might be a week till we get around to it, but it's pretty close. So you can see, okay, what are these companies actually worth versus what's the stock price at? You can see the short interest. You can see the rates that they're booking at, and not just the rates that they had in the past quarter. And you can see all that. We've got rate data for individual companies. I think going back all the way to 2005 in some cases, early 2000s. So you can see how they performed over time, but you can also see how they're performing in the current quarter. So before earnings comes out, you can pull up a chart of Scorpio or TK or Ardmore, and you can look at their fixtures by vessel class and see if they've been outperforming or underperforming the market.
So you can kind of see what their earnings are going to be before they are announced.
You can definitely see who's going to outperform and who's going to underperform. Now, calculating the TCEs is hard. That's data that's going to be very specific to the ship, to the terms of the deal, etc. So we're not giving people precise earnings forecasts. We're not saying this is exactly how much they're going to make, but we are giving people raw data on the deals that the company is actually doing, so that you can see, for example, that Scorpio has really done well with fixturing their MRs above market. And so then that kind of reinforces some other things that you already know about the companies. Like you know that Scorpio has a lot of scrubbers. And so you can actually see in the fixture data as the quarter progresses and that HSFO spread rises. Oh yeah, that's why these guys are making more money. That's why they're getting the best, some of the best fixtures out there because they've made this big scrubber investment. This is that investment paying off. So for me, back in October, November, I think at least a lot of our subscribers, it gave some of them the confidence to either buy or hold because the site launched November 15th. And the lows for tankers, I would say, were the end of October, early November. So I think that the launch of the site really coincided with lows in the stocks. And the part of the pitch that I initially sold it on was, don't sell at the bottom of the cycle, don't buy at the top of the cycle. So my intention is really to give people data that helps them make informed decisions using the information and not a narrative that an analyst is giving them. And we got some really encouraging news last week. One of our members has a 7-figure position in tanker stocks that he started building last year in May. So he was buying in at the top, and he was one of the earlier tanker data subscribers. He kept averaging down in the fall, in September, October, November, and as of today, he was up 12% on that position, excluding dividends. So not very many people have the kind of balls this guy has to, have a 7-figure position and then keep averaging down on it. But, lots of people have said, thank you for the service. Thank you for the product. It helped me to look at the data and see the market information and not just rely on the spin that I'm getting from other analysts.
Thank you for that description. Can you give my listeners an idea of what it costs per year?
It's $500 a year. It's $60 a month. So you save some from doing the annual subscriptions, and I do promotions every once in a while. It's never going to be as cheap as it was last year. People that signed up at the beginning got a lifetime rate of $175 a year, but anybody that signs up now still gets the rate that they sign up at locked in.
I like promotions. Can we do some kind of promotion for maybe my people that are listening?
Yeah, definitely.
So make us an offer. What can we do for, like, let's say, I don't know, first 10 people that sign up? What can they get?
15% off, and you get a cut too.
Okay, and how do they do this when they're on your website? How do they get this 15% discount?
I'll give you a coupon code, and when they go through the checkout process, they just need to apply the coupon code.
Okay, can you make that coupon code my first name?
Yeah.
Okay, perfect. So that's thanks for the description on this. And now let me ask you a couple more questions. So we talked about the oil demand. You thought that it would maybe reach the 100 million barrels per day. Do you know where we are, like, right now?
Yeah, so I think right now we're tracking around 97. So we've basically still got some time to go.
Yeah, but I would say 97, that's pretty good considering where we were, a year ago, half a year ago.
Yeah, it kind of depends on who you ask. But yeah, so Goring basically said, I mentioned that report earlier, and it's in their it's in their Q4 report. So let me read something that they put in that Q4 report on oil. So they're super bullish commodities, super bullish oil. We've spent years studying energy trends in emerging markets. Over time, non-OECD countries have gone from consuming 40% of all primary energy to 60%. As an emerging market gets richer, it reaches a tipping point and starts to consume more energy. Once an economy is developed, it reaches a saturation point and energy demand moderates. Since 2000, non-OECD countries have grown their primary energy demand per capita by 65% compared with a reduction of 10% in the OECD world. Even following 2 decades of strong growth, non-OECD demand is still 70% below OECD levels, suggesting more growth is yet to come. Non-OECD real GDP per capita is expected to double over the next 20 years, suggesting these trends will continue. Instead, the EIA projects emerging market per capita energy demand will fall by 20%. Simply put, this is impossible. Over the last 2 decades, real GDP doubled and energy demand rose 60%. Even if this relationship is cut in half, the next doubling on GDP would result in energy demand growing by 30% by 2040, not falling by 20%.
Okay, thank you. And let me ask you. Go ahead.
So let me simplify that analysis just a little bit. Okay, what they're saying is that the EIA estimates, the EIA forecast is based on impossible assumptions, and those assumptions may be politically motivated. I mean, we all see World Economic Forum stuff. We see politicians jawboning about green energy and the end of fossil fuels. And it's a constant stream of this stuff. They don't want people to invest in fossil fuels. They want all the money to go into renewable energy capacity. Okay? And the reason uranium's going crazy, the reason nuclear stocks are going crazy, the reason that fossil fuels are coming back in a big way is because we're seeing that these people don't understand the science. This stuff just can't happen. We're not going to be able to meet our energy needs. So they're extremely bullish on oil, and they think that the EIA is making faulty assumptions. And I don't know if that's politically motivated or if they're just picking random numbers out of a hat, but I tend to agree. I don't think oil consumption is going to go down in India, China, Africa, Bangladesh, Pakistan. There's a lot of countries out there with large populations and high growth rates. And high birth rates. And I think oil demand is going to continue to expand rapidly for those populations. People, a lot of them, I think the investors in this space are living somewhere like Norway, where they see really high levels of EV penetration. I've lived in Latin America for 5 years, and I've never seen a Tesla here, a single one. Now, I do know people that live in Latin America that they say they've seen a few Teslas over the years. One guy said he'd seen 6 Teslas in 6 months. Seems like an exaggeration to me because I've hung out in some rich areas in Latin America. I've never seen one. But here in Panama, the car that everybody wants is an SUV. It's something with high clearance, with off-road tires, and this isn't an edge case. Most of the developing world, the roads are a mess. You got potholes all over the place, huge speed bumps. There's tons and tons of infrastructure work just on the roads that needs to be done before electric vehicles are really an option here.
Well, so, I think it goes back to the point that if you are in a poor country, you just want a car, okay? You at that point you don't care. If you're in a developed country, okay, you've had a car your whole life, and you're looking at green and recycling and things like this. People in the developed countries just don't have this on their mind at all.
Absolutely. If you're talking about a country whose per capita GDP is a few $1,000s a year, maybe one person in the family owns a car. In the U.S., I think every person in the family owns a car. So, making these long-term demand forecasts like the EIA does, based on energy consumption declining in developing countries, implies that their standard of living is going to decrease. So what amazes me is that in the same breath, politicians can talk about closing the inequality gap while also limiting per capita energy consumption growth. Quality of life essentially is energy consumption. And unless we're going to, en masse adopt nuclear energy and we're going to start building new nuclear plants everywhere, I just don't see the reliance on fossil fuels ending or even declining in any meaningful way in the next couple of decades. Look at what's happening in Texas right now. You got windmills freezing. You got solar panels covered with snow in Europe. Japan's spot power rates went crazy. 6 million people are experiencing brownouts or blackouts in Texas. People as far away as California are saying that the energy issues there might affect their grid. So if a harsh winter now can effectively take down the U.S. grid. I mean, my home state of Kentucky, which is a long way from Texas, I think there are 200,000 people there without power right now. So if our grid at 2 or 3% EV penetration can't handle the load in the winter, what are we going to do at 50% EV penetration? That energy consumption doesn't end. We just shift the fuel that we're using. To run those batteries, we have to generate that electricity somehow. Fossil fuels are a very stable, very transferable, long-lasting form of energy. That oil that's in the ground, it's been there for millions of years, and it still has the same energy potential, that it had 100 years ago, 1,000 years ago, 10,000 years ago. The solar panels only generate energy when the sun's shining. The windmills only generate energy when the wind's blowing. And the base load factor for our energy systems, how much power do we need to generate at all times for when something goes wrong with the renewable options? It's really significant. If you look at studies on Germany has been going into the renewable space longer than anybody else has. They've got tremendous subsidies for solar, and Germany's spare power capacity is incredible. And they've got all of this energy capacity that they're not using because they need it to be there in case something goes wrong. I can't remember who said it, but there was one commentator who said, in thousands of years of human history, this is the first time that we've gone to inferior sources of power generation.
Very, very interesting, Calvin. Thank you very much for this summary like this. Last couple questions I have for you, if you can touch on, is refinery closures and destocking.
Yeah. Okay, so the refinery closures, these started out because the demand wasn't there, right? COVID happened, everything shut down at once, people stopped driving. There's no need to keep refining fuel. Refining is a very, very on-demand, just-in-time type of business. And if people aren't using fuel, then you're building stockpiles. So we basically built all these big stockpiles. First in crude oil, that was the contango. That's why tanker earnings went nuts in March, April, May of last year. Then after you see the crude builds, you also see product builds, during the same time. So refineries were creating too much product, and when you create too much product in that commodity industry, obviously there's no demand for it. The price falls. So refining is very much a scale business. One of the main things that you should look at if you want to predict how profitable refinery operations are going to be is the capacity utilization. If refineries are utilizing a higher percentage of their capacity, it means that demand is strong. It means that margins are good. You can look at what are called cracks, basically the differentials between the price that they're paying for their feedstock, be it crude or HSFO or whatever, and the price that they're selling their refined products for, jet fuel, diesel, etc. So in refineries, we saw this dynamic where all of a sudden there are no planes in the air, so jet fuel prices plummet. Jet fuel is getting stored on ships. Scorpio talked about how it had stored jet fuel for one of the first times ever back in, I think it was Q2. So the world's not using any fuel. The price of fuel drops through the floor. Refineries start shutting down. When I started telling people to go long PBF Energy, which is September, October, they had just shut down some of their refining capacity, but overall 5% of U.S. refining capacity had been shut down. And this has happened in a lot of other places in the world as well. We've had refineries shut down in Asia. Australia shut down a big refinery. So when you shut down refining capacity, you have a mismatch between where the consumers of fuel are and where the fuel is being produced. So if you take Australia as an example, if Australia shuts down a 200,000 barrel a day refinery, which they did, then all of a sudden, if you've got 200,000 barrels a day of demand and you don't have domestic capacity to produce fuel for that, then you're going from importing crude to burn at your refinery, and you've got onshore crude storage. You're going from importing crude to create product to now you need to import all of that product. You need to import your diesel, you need to import your jet fuel, you need to import your gasoline, your kerosene, your naphtha, and that requires a lot of product tankers. So if we've got fewer refineries and product is going longer miles to get to its end destination of being consumed, that's obviously good for product tankers. That increases ton miles. It may or may not be good for crude tankers. Crude tankers, one of their main customers is refineries. So if a lot of refineries shut down, it kind of depends how the reconfiguration happens. Ton miles is basically where am I sourcing this crude, what refinery or storage terminal am I transporting it to. So there are some people that have done more in-depth analysis on that. The consensus right now, more or less, is that the refinery shutdowns are good for product tankers, and they're either bad or neutral for crude tankers.
But what happens if they put them back online? Would this reverse the whole situation and be better for crude and not so good for tankers?
So yes, but some of these refineries have closed permanently. Refining is a very capital-intensive business, and it's not super easy to restart a refinery. It's a lot of capex, and unless you're extremely confident about the future of the market, you're not going to want to make that investment to restart that refinery. So a lot of these refinery closures are considered to be permanent. And then some of the refinery projects that are coming online, when I spoke with PBF evaluating that investment, they basically said, look, we don't know exactly what's going to happen in the future, but we never add refinery capacity to our calculation until those projects actually come online, because they get canceled all the time. Refinery projects get canned all the time.
Okay, and can you talk a little bit about destocking, both product and crude from the storage?
Yeah, so basically this is just inventory levels. The crude inventory levels are now back in the 5-year average. It looks like we're going into actually a supply deficit for crude. So that's going to be a really interesting dynamic, because if we're in a supply deficit and we can't source those barrels, the market moves into a backwardation structure, meaning, people want oil now. Now, something interesting to note, again, the biggest customer for a barrel of oil is a refinery. So, right now you have a lot of refinery closures in the U.S. Due to cold weather. I think, I want to say 10 refineries are offline today because of cold weather. So if those refineries are offline, they're obviously not consuming crude. Anyway, we're already in the 5-year average range. If things continue, it's not going to be cold forever. Spring is around the corner. If we continue on the path that we're at, it looks like we've got a supply deficit. It looks like we're going to keep drawing. Dr. Anas Al-Haji had last year made a very contrarian call that he thought by the end of the year a lot of the destocking would already be done, and we'd be moving towards a supply deficit. That was not a very popular consensus view, but it seems like he was right. And when PBF announced their Q3 results last year, they said, look, we've got inventories already moving back into that 5-year average. I think it was diesel inventories were already there. Gasoline inventories were following. So you can look at the EIA numbers on current stock levels. They publish stock levels for the U.S., OECD, non-OECD. The OPEC report also has some of that. We include a lot of that data in tanker data as well. But you'll see that there have been consistent stock draws since the height of the contango. So people, I think, had the fear initially, there's so much oil out there, there's so much product out there, we're never going to work through it. And so then there wasn't enough investment. Refineries got shut down, drilling projects got canceled. Biden comes along and says no new drilling, no new leases on federal lands. The Norwegians are canceling projects. You've got strikes elsewhere. The OPEC actually kept to its cuts for the most part. I think in some cases there was overcompliance. So, there's been less supply than people anticipated. There's been more demand than people anticipated. That's a scenario for lower stocks and higher prices.
Thank you very much, Calvin, for this interview. It was fantastic. Obviously, you live and breathe tankers. So for those of you that are listening, if you're interested, I will put the link to his website in the description below, and then I will put the coupon code if you want to get a discount. Calvin, anything else would you like to say before we wrap it up?
I think the last time we did a call, it was kind of like, why the hell's everybody selling tankers, right? That was our last call, more or less, right?
Yes.
Right. So now I think, as of today, tankers are mostly higher than they were when we had that last call, if I remember correctly. We were kind of in the doldrums. And it's just really interesting, how these markets move, and the gaps between the fundamentals and the prices and people's perceptions about where things are going. So I would just say, as closing remarks, I find all of the entire energy market, not just tankers, but the entire energy market, and really, commodities and shipping, fascinating. It's not the only area that I'm focusing on. I'm also planning this year to release sites in some other shipping sectors, as well as mining sectors, and I plan on later releasing a refining site as well. So it's just, all of this stuff kind of goes together, right? If you want to understand tankers, you really need to understand refineries, and if you want to understand refineries, you need to understand oil demand. and you need to understand the oil production. So the human energy consumption, our energy systems, it all goes together. And you can't just look at one part of it. You can't just look at tankers. You have to look at, okay, well, what's the actual payback on a solar panel investment? I recently was looking at putting solar panels on my hotel, and looked into the numbers, and these guys are telling me, hey, yeah, bad news. That 7-year, 8-year payback quote that we gave you, that's not really realistic unless you switch all of your hot water heaters from on-demand electric to gas. So the solar people are literally telling me that if I want to have a realistic payback on the investment, I need to rely more heavily on fossil fuels. The solar people are telling me that. So the whole energy theme in general, and the commodities theme. You got to understand the steel, copper, oil. I know you're definitely big in the copper space. You have to understand the commodity transportation, the refineries, how it all fits together. So it's tankers are just a piece of that, and I think they're one of the most interesting pieces because let's face it, oil is still the most important commodity on the planet, outside of maybe wheat or corn, soybeans, right? Maybe oil is the most important because all that farming, it happens with machines that are powered by diesel fuel. You can't get agricultural yields if you don't have tractors, and if you don't have fertilizers, and understanding how all these systems fit together, I think, is really important for seeing what's going to happen in the coming years and the coming decades. But I think you have to kind of look at it as a whole. You can't just say electric cars are the future. You can't just say renewable energy is bullshit. You have to look at how it all fits together. Think about what's realistic. Read the stuff from people that don't agree with you. Read the stuff from people that are on the same page, and then try and figure out what reality is.
Wow, perfect. Thank you, Calvin. So let's leave it at that. Yeah, thank you so much for the interview.
Yeah, thanks a lot for interviewing me. You have a good day, and great call again on Orico.
Thank you.